If we save somebody $20,000, if they invested that at only 4% over the course of 20 years, it would give them an extra like 600 something thousand dollars.
If you're investing, investors.
The podcast for all things real estate investing.
So welcome back to another episode of Investor One-on-One. Today we're diving into a topic that every investor and business owner cares about, but most don't fully understand: how to keep more money you make. Our guests from One Stop Tax Strategists specialize in covering the tax savings that most accountants miss. Instead of just filing out forms, they dig deep, asking the questions that actually lead to less money paid in taxes and more money staying in your pocket. On average, their clients save tens of thousands of dollars each year, and today they're breaking down how you can start spotting those opportunities in your own business. So please welcome to the show, Melanie, Sikma, and Byron McBroom.
All right.
Thanks for having us.
It's good having you too. So yeah, let's start off with how you guys got into this industry and what led you to start One Stop Tax Strategists.
Well, Dad, I'll let you take that away first, your little history.
Okay, well, I actually got started in 1981. I graduated from college, and when I graduated, there was a glut of accountants. So getting a job wasn't the easiest thing in the world. So I remember mailing out my resumes, didn't have much luck. I actually drove down to Stockton. I lived in Sacramento, California. And I drove down to the next town and dropped off a couple resumes. I drove down to Modesto, California, and I dropped off one resume. And I looked around and I said, this town sucks. and so I left. And of course, that's the people that called and hired me. And so then I met my wife. She was still attached to the umbilical cord, so I was stuck down there. And it turned out to be a great thing. So I love living here. There's nothing here, but you're close to everything: the ocean, the mountains, Yosemite, everything. So, but anyway, I was working for this accounting firm, and they were cheap sons of bitches. Man, they wouldn't give me nothing, no recognition, nothing. Now, maybe I didn't deserve it at the time. I don't know. But so I left them and went to work for the Groupie Company, which was like a Fortune 500 builder. I mean, massive over the nation builder. And I worked in their tax department. And this was great because at the accounting firm, I learned what the little people do. And when I went to work for the Groupie Company, I learned what the big real estate investors do. So that was really, really eye-opening for me. From there, I stayed there a year or so, went to work for a construction company that went broke. And I learned about what not to do in a business and how to struggle with no cash flow. Because this company lost $1.8 million on a $200,000 capitalization. So they lost $1.6 million of other people's money.
Oof.
And then from there, they talked me into start my own business. Basically just bumbled through the years, got really lucky. I landed American Savings and Loan as a client. So within 6 months, I was actually had to have 10 CPAs working for me. So I was one of the larger firms after 6 months of being in business. That was quite an experience. I wish I could get that to do over again. I could really make some money with it. But from there, we just bumbled through. You just kind of go what comes along. And over time, we just gradually picked up more and more and more real estate. This business particularly was started because Melanie and Tiffany were actually working for me in my other firm. And we were signing up so many people that my employees had a revolt. They said, no mas, no mas. Okay. And so then we basically formed partnerships with other CPAs to do the work and formed a separate entity, took it out of my company, and started partnering with other CPAs. But the problem we had was we couldn't find quality CPAs. So now I know what the clients go through, finding that quality CPA. I mean, we'd give the stuff, lay it to them on a platter, and they'd mess it up. And so basically what we did is about a year and a half ago, we took everything in internal, and now we're controlling the quality control and everything. We are growing at a little slower pace so we can manage it. Melanie's the CEO. She runs the company. I'm supposed to be just a mentor, but that hasn't worked out too well.
He enjoys it too much.
It's an amazing story, man.
And that's kind of led us where we are. We love talking to people. That's why we give unlimited phone calls, so they will call. We don't want there to be barriers to calling. And just love coming up with ideas for people to make some money.
So can you tell us more about, your business today? Do you guys work with just investors, or what kind of people do you work with?
Really, we can help any business owner in the United States. As long as they're making money, we can help them save it. but we tend to niche down in the real estate department. It seems like about 80 to 90% of our clients own real estate or real estate investors, and so it tends to just magnet to be a magnet towards us.
For
But a lot of
sure.
times that's true because most business owners invest in real estate also. I
Hmm.
mean, I've had pharmacists, I've had contractors, and they all seem the real wealth I've noticed. I don't have too many clients that got wealthy through the stock market, but I have a lot of clients that got wealthy through real estate.
Yeah.
And so,
Couldn't agree more. Real estate is for everyone, and it's an amazing investment. So, as we spoke
Mhm.
about other accountants, they're just focused on filing forms, very old school. They don't do as much as they can. What makes your approach to taxes different?
Well, I would say we just systematize creative tax planning. So what we do is we all work together as a team to add to we have a tax planning checklist that we run through with our clients at the end of every year. And I feel like we're just continually adding to it. And so it's putting our brains together, making sure that we do tax planning where a lot of CPAs, they're more historians where they're only meeting with you during tax season, where we meet with our clients before the end of the year and make sure we run through that checklist and just look at every angle, look at the how what my dad always says, it what is it, how to skin the what at every angle. Do you ever say
More than one ways to skin a cat, or what
more
is
than
it?
one way to skin a cat? So we look at all the ways to skin the cat. How can we run different scenarios so they can actually see the bottom line of what it's going to save them. And then my dad, for example, he doesn't even serve clients. He is more of the high level stuff that all of our CPAs can go to for help. And so he's always working on new ideas to add to the checklist
Mhm.
as well.
For
Let me
sure.
give you an example of a brand new idea we just did. And keep in mind, a lot of these aren't original. They're stolen from other clients that did it or people we talked to. But we were at a life insurance conference, and this guy tells me he was he would buy houses, almost tear them down, and then rebuild them and then sell them off. He'd leave part of it there so he could have the permits and the property taxes or whatever the same. But what he did is he bought a house he was going to tear down, and he contracted with the local fire department and let them do all their practicing on the house. So they were in there with sledgehammers knocking holes in walls and the roof and everything. And the benefit of that is if you look at the value of the house when he bought it minus the value of the house that it was after it was all beat up, he got a charitable contribution for that deduction.
Wow.
And what that normally, when you tear down a house, you take the cost of the house and you add back the demo as a construction cost. But he was able to uh, basically take the lower value, and write it off today. What that did is lowered his basis. So in effect, he got an ordinary loss for the uh, charitable contribution, and when he sells it later, he can get a capital gain on the sale. So he effectively converted that charitable contribution as an ordinary loss and made it a capital gain, which is taxed at about half the rate. So now, of course, we added that to our checklist, and it'll be a discussion item with a lot of our clients now.
That's awesome. You guys have been in this industry for such a long time. I feel like you guys seen so many different scenarios, and you guys are very creative, as that story that you just said. For a brand new real estate investor that's watching this right now, what's the smartest way to capture as many deductions as possible from the very beginning?
I would say their biggest thing is to get, like, as boring as it sounds, to get their bookkeeping in order because that's the basis for all tax planning. So have a separate set of bank accounts, separate credit cards for all your business transactions. Make sure that if it's a business expense, you're putting it on those cards. And then if you have a question, you can put it on those cards and it'll just flag it for later. For bookkeeping, it's just any system that automates the process. So we like QuickBooks Online, but some people like Stessa or other, Zero. There's other options. But as long as it ties into your bank accounts and it automates the process, it makes it a lot easier. And then if you're not going to do it, just hire a bookkeeper. If you're going to do it, make sure you're doing it right and get some training. But just make sure that that's getting done right. So if you're at, let's say, the 30% tax bracket and you have a $100 deduction, and you miss that $100 deduction because your accounts are intermingled, you're throwing away $30 because it's basically whatever the deduction is, time your tax bracket. That's how you know how much it's going to save you by deducting it to the business. So it's important to do that. We have a tax course. I believe we have it in our drive. We switched it off of our software, so we'll have to get it up somewhere else. But we do have a course that we'd be happy to share out. It just might be an informal platform that it's on, but that would teach them some deductions as well.
That's awesome for sure. And I'll link that below. And in your opinion, what are some commonly overlooked tax strategies that real estate investors should be paying more attention to?
Well, we have a 8-step tax solution. We call it our Live More framework, and it's how you can pay less tax so you can live more. That's where we base it off of. It ties into our mission statement. But basically, the good set of books is one thing, that's the one thing that a lot of people overlook, and they don't realize how important that is for tax planning. The next is having a proper entity. And so making sure that whatever entity you have your investments in is the proper one. So for real estate, it really depends on what type of real estate you're doing. If you're flipping, for example, or doing wholesales, that is, if you're netting over $70,000, $60,000 or $70,000, it should be in an S corporation to eliminate self-employment tax. If it's rentals, they should be in a single member LLC or a partnership. And so that can also make you overpay if you have the wrong entity, or it can flag you for more audits. So being in an S corp alone drops your audit rate 7 to 10 times than if you were just in a single member LLC or a sole prop. So little things like that can matter. The third step is to rent your house to your business, do the Augusta rule. Have you heard of that? That's all over TikTok and Instagram. But you can rent your house to your business for 14 days tax-free. And if you have an external entity, so a partnership or an S corp, you can rent your house for corporate board meetings and not pay income tax on those rental agreements. Dad, you want to go over what it legitimatizes that the court case?
There's actually a court case on this, and the main things is you have to be able to pay a reasonable amount of rent. So if you have a $300,000 house and you're paying $5,000 a day, that's kind of a little questionable. So what would that house rent for on a 1-day basis through Airbnb or something like that, but get a reasonable rent for that house. And then the other is you have to be able to show that you had the meetings. The court case, there was a guy, 3 guys, they all took it. They were partners in it. And one guy got disallowed, one guy got partially allowed, one guy got completely allowed. And the main thing was reasonable pay and be able to prove that you had the meetings. So what we always do is we always give people rental agreements. And then we always give them sample, fill in the blank minutes so they can do minutes for the meeting. And then the other thing you do is just make sure you put all that on your calendar so it shows that on your calendar that meeting happened. And then that there alone will make it so that you're pretty safe on that, as long as all the numbers are reasonable.
My dad, for example, on that one, he rents his house for $1,000 a day. So he gets a $14,000 deduction that he doesn't have to pay income tax on.
And it's nice because we have a lot of people who live in the Bay Area, and their houses are worth $3 or $4 million.
Yeah.
I'm sure a lot of the investors here have that too. But it's all, a lot of times we use as a benchmark maybe 0.1%, but that's just a rough guideline. You really need to anchor it out and find out the real value.
Another common one is a lot, the kids' payroll one's thrown around a lot. And so if you can pay your kids $15,000 a piece tax-free if they're under 18, and if they're working for you as a parent. The way to structure that, though, that's overlooked is if you have an S corporation, you don't want to pay them from your S corporation. You want to pay them through you as a sole proprietor, because you'll avoid payroll taxes that way. If you pay them from the S corp, you're going to pay payroll taxes, and that's about $2,000 a pop extra that you're going to pay per kid. And so it really does add up, and it matters how you pay it, making sure that it's reasonable work for reasonable pay. You don't just get to pay them because they're cute unless they're your models for your business. Then they can be cute. That's what I do with my kids. They're just my models for my business, and then I just use them on my social media, use them on our website, speeches, etc.
Wow.
Yeah, there was actually a court case on this one too, and it all boiled down to reasonable work for reasonable pay. So what we do for people is we have a modeling agreement we have them fill out, and then we basically researched how much a model makes. And a model makes $175 to $125 an hour with a 2 to 3 hour minimum. So in our agreement, it has 3 hours at $175 an hour per photo shoot. And then you just make sure you take regular pictures, make sure you post them. So, you don't want to get to the end of the year and the IRS agent wants to look at your Instagram account and there's not a single picture of your kids.
Mm-hmm.
So that actually happened to one of my clients, and he lost the deduction because he didn't have any proof that he actually used them.
Wow.
You just
So
transferred the money. Yeah, and then the next one would be our next step would be M is move income strategically. So this is our ebb tide plan. And ebb tide lowers all boats. So it's look at all the lower tax brackets around you and how can we shift some income to them. And so my dad, for example, he helps my grandma out. She's 92 years old. She's doing awesome health-wise. She's actually still does the books at her church. And so he just hires her he opened up a separate company that she's a passive shareholder of. And she doesn't have to do the work. She's just a stockholder, just like if you own stock at Apple. But he hires that company for services. And so that company provides a service to this company. And so he shifts essentially 80 grand of his income to her lower tax bracket through that company. And so it's taxed at her rate instead of his. And so it saves him about $40,000 in taxes, where she pays only 10. And so it's a net profit of about 30. And then what he does is he lets her keep half of it. She gifts back the rest. And then it basically, like my dad always says, it changes her life. It allows her to live the life that she loves. And then he gets to make a profit on helping her out.
For sure.
I get to be the fair-haired child, but I'm making a profit on it.
You guys really know the ins and outs of this business. It's amazing,
Oh.
Yeah. And then you can also do that like with kids in college. If you have a kid in college, you can open up a corporation. They have to do some work because there's different rules for kids in school. Or if just kids over 18 that are at a lower tax bracket, really anybody around you. We have the baby mama plan or my dad always says the indigent brother-in-law. So if you have a brother-in-law that is at a lower bracket, you can shift some income to them. And so Grammy Mammy plan, all sorts of plans. So we could do all variations. It's just looking at, everybody around you, who can we spread the wealth to, and then have them gift back a portion of it.
You just got to make sure they get the joke. They got to give it back. And I had that happen with one of my clients. He put some money in his grandkid's name, and then the grandkid went out and spent it immediately. But the grandkid was supposed to put it into a family partnership, and then he was going to grow all their wealth and pass his inheritance through with the family partnership. So anyway, she got knocked out of the will for $7,000. Pretty stupid on her part.
Yeah, that is.
He's worth about 40 million, and she got knocked out.
The next step would be offset and defer. And so this is our kick the can plan. So if you have, somebody that, if you have business, you have a lot of marketing, payroll expenses, what we do is we look at your P&L. We figure out what expenses can we justify in another company. And then we can open it up with a November year end or any fiscal year end. And then the way that we'll teach you to mark up the services, teach you to funnel the funds back and forth. It's a way that we can get a pretty big tax deferral with expenses you're already paying. So for example, if you had $1 million payroll expense, we could get you a $2.8 million deduction with pretty little cash. And so it's like an interest-free loan from the IRS. So we had a client that did this, and we were able to get him up to a $15 million deferral over the course of several years. He used that to fund real estate, and this was back in 2010. And he was able to grow that into a portfolio worth of $26 million now, with money that he would have thrown to the IRS. So pretty cool.
We know it's $26 million because he's in the middle of a divorce and the wife gets half of it now. So
yeah, you could totally save so much money in this industry, with you guys especially. It's insane. But can you break down what it actually means to qualify as a real estate professional for tax purposes and why that's such a game changer?
Dad, you want to do that one?
Sure. So the benefit of being a real estate professional is that you can take the losses and offset your other income. So let's say you're a dentist or you're a chiropractor, somebody you're making, say, $500,000 a year. Okay. And as a W-2 person, there's really almost nothing you can do. You can do the short-term rental loophole, but that's about it. So, but being a real estate professional, it allows you to take losses from real estate and offset your normal business income. So for instance, if I was just a dentist or a CPA making $500,000, I can't buy a rental property and take those losses and get some tax savings because the IRS limits that. But if I'm able to qualify as a real estate professional, I can take, or my wife can, my spouse can, then I can either, well, just one of us does, I can take that loss and offset my CPA practice income and get a big tax savings. So to be a real estate professional, one, you have to spend at least 750 hours in real estate. And then you also have to spend more time than in any other profession. So it's very difficult. If I'm a CPA working full time at 2,080 hours a year at a business, I'd have to spend over 2,100 hours in real estate. Well, that's very difficult to have happen. So a lot of times people will have a spouse that maybe is a realtor, because that qualifies as a real estate professional. Or if you just have a whole bunch of rentals, you'd have the spouse manage those, qualify as a real estate professional, and that way then you could take those losses and offset it. But it's 750 hours, it's more than any other profession, and then you can take those losses. That allows you to invest in syndications and take those losses. It allows you to do a lot of things that you can't do as a non-real estate professional. But it's mainly the 750 hours and more.
Mm-hmm.
More
We have
than-
a flow chart that we could actually send out if people don't know if they qualify for it. It's a yes no flow chart reasoning thing. So if you want, we can send that over to you, and you
Yeah,
can.
and there's some professions that qualify automatically, like a realtor does. If you're a contractor, you automatically qualify. That contracting work counts as a real estate professional. So on that flow chart, there's a list of the people that qualify automatically.
Mm-hmm.
Awesome. So we'll link that below as well. And following up on that, what are some ways investors can minimize or even avoid capital gains when selling or holding their properties?
So we have, that's actually the last step. Actually, the last step is to employ your savings. But if the step before that is reduce capital gains. So, Dad, you want to talk about, we have a few options, but the deferred escrow trust is our most commonly used one. So, Dad, you can kind of briefly mention that one.
And what a
does.
deferred escrow trust is, let's say you're going to sell a $2 million gain on a piece of property. And obviously $2 million, you'd have a 20% tax bracket. You'd have a net investment income of almost 4%. In California, you'd have a 13% gain on that. So obviously, if you're living in Texas, you're not going to have that same 13%. But in California, you'd have 37% tax on the sale of that property. So that'd be $740,000 you'd pay. That's pretty painful when you've had this thing and put your blood, sweat, and tears in it. So, but normally if you sell a property and finance it yourself and carry paper, that's called an installment sale. You only pay tax as you collect the money from the buyer. Okay, so if they pay you over time, you spread your taxes out over time. So what we do is just reinvent that, but in our controlled environment. So what we would do is we'd form a trust. You sell the property to the trust on the installment sale, which means, and you 100% finance it. So the trust puts zero down. You have interest only for 20 years, and the trust just pays you interest. You only pay, and then the trust sells the property for cash. So the trust has the $2 million gain in it. Well, the beautiful thing about this is you only pay capital gains as the trust pays you back on the loan. And that can stretch out over years. You can do it a little bit at a time, but there's a massive savings on this. In my example before of the 2 million, if you break your capital gains into under 250 a year, you can get it taxed at 15% instead of the 20%. So there's a $5,000 permanent savings. Also, if you're under 250, you don't have the net investment income tax. So that's 4% that goes away. And also, if you're picking that income up in small pieces for California, your tax on that goes from 13.3% down to only 9.3. So therefore, I don't know why California likes the 0.3, but that's what they do, 9.3, 13.3, 10.3. But anyway, there's really you take that 4%, the 5%, that's 9, and then you add the 4% savings, you have almost a 13% permanent savings just by stretching it out over several years. And then the deferral part, you can pay it in 20 years with the same amount of tax, just 20 years later. With the inflation we've had, that $700,000 in tax probably will boil down to be about $200,000 in equivalent dollars paid 20 years from now. And just think, you've got that $700,000 extra money to invest, and you get to keep the profits on that. That doesn't go to the government, it goes to you. Of course, you got to pay tax on that money as you make more money. But this is really just a beautiful thing. And the main thing is your trustee you have to have an independent trustee, which means it's not a family member or someone you control, not an employee or family member.
As I said, you guys have been in the industry for a while. If you guys have to share one real life story or an example of how you helped an investor save a significant amount on their taxes, what would that be?
Hmm. I would say, I mean, Juan's the best story, the $15 million into deferral that he took as a loan and funded real estate, now has 26 million. That's pretty sweet. Dad, do you have any other stories off the top of your mind?
Let's give the specifics of what we did for that.
Yeah.
Mhm.
Okay, so Juan was making about $1 million or so,
Yeah,
a little
net.
bit more in his contracting, he's flipping real estate and stuff like that. And so what we did is we did the Augusta rule for him. We talked about renting the house. He had two kids that were under 18, and he had a
Mm-hmm.
kid in college. They
We
were
see.
going to Arizona State. So
Mm-hmm.
what we did is we formed a corporation in Arizona for that college person. And by showing that they were financially independent, they were actually able to qualify for in-state tuition in a lot faster time frame. So not only did he save the money on it, but uh, he also was able to get in-state tuition, which is probably more savings than the taxes. And then for him, he was also helping his mom out. So he basically put his mom and the college student on the same corporation. Anyway, if you add everything up we did for him for permanent savings, it was about a $67,000 a year savings because he saved about 20,000 with his mom. He saved about 18,000 on the child. He had the two kids. There's a $30,000 deduction. He had the Augusta rule for another 13,000. So all that added up to about almost a $70,000 savings for a guy. And I mean, he makes a lot of money. So and then plus with him, we did the deferral program, that really gave him a whole bunch of working capital to go out and really expand his real estate empire. But you don't have to be a big guy to save a lot of money. You might be a small guy making 125,000 a year, and the savings you get from just doing the kids' payroll and the Augusta rule, that might save you $10,000 or more, and that's more important to you than the 70,000 we saved one.
I did the
So,
math on just saving, if we save somebody $20,000, if they invested that at only 4% over the course of 20 years, it would give them an extra like 600 something thousand dollars. And that's just by tax planning alone. That's not by increasing their business, reducing their living expenses, or anything like that. It's just by strategically planning.
and we don't recommend getting this tax savings and just living larger. That's not what live more means, okay? It just means using that money to achieve your dreams. So then, if you
Accelerate really the your
Mhm.
dreams.
For sure. And we spoke about so many strategies and so many stories, but if an investor wants to set themselves up for success coming up on tax season, what's the number one habit or system that they should start today?
Make sure if their CPA doesn't do any tax planning, and it doesn't hurt to get a second opinion regardless. If we get a contractor, you're going to have somebody come and give you a couple quotes. And so we just offer a second opinion. It's a free tax assessment. And I just make sure that they're planning. But if they want to have us give them a second opinion, they can book a call with me. I'll run through some questions. I'll let them know if their CPA is doing a great job. If they're not, then I'll let them know what things they're leaving on the table. Maybe if they want to learn what it looks like to work with us, we can always offer that as well.
Awesome. And on a personal level and on a career level, what's next for you guys?
Next, just keep growing. We're growing our team. We're expanding and trying to serve as many clients as possible, and doing it really well. My goal is to just make sure our clients they feel very cared for. They feel like we give them a profit, and then, yeah, just making sure that we're making an impact in people's lives.
And I'm working on getting my golf handicap down, which is very, very frustrating. When I die, I want to come back as a golf god.
Oh
And
my
I'm,
God.
I'm, I'm going to let people play really good for 14 holes, and I'm just going to abuse the heck out of them.
Amazing. Melanie Byron, thank you so much for sharing your expertise and breaking down so many strategies today. that investors can benefit from. For anyone that's hearing this and wants to connect with you, learn more about One Stop Tax Strategists, or even get guidance on their own tax planning, what's the best place for them to reach you?
They can either they can email me, Melanie at osts.tax. Our website's osts.tax, so that makes it nice and easy. Otherwise, they can follow me. I'm on Instagram quite a bit, Melanie Sikma, or they can search our company as well. So if they're on Instagram that way, otherwise they can reach out and at osts.tax and we can set up a call.
Awesome. And to everyone watching and listening, thank you for tuning in, and be sure to stay connected for more conversations with the nation's top investors and experts right here on Investor 101. Thank you guys.
Thank you.